The alliance between OPEC and Russia that has been in place over the past few years pursued the objective of rebalancing supply and demand in global crude oil markets in order to ensure sufficiently high prices to meet the budgetary needs of Saudi Arabia and the other cartel members, as well as Russia. However, as it turned out, the primary beneficiary of these measures was the US shale industry, which operates at a rather high break-even cost structure, requiring crude oil prices between $40 and $50, while the US shale sector gained about 4% of global market share. Saudis and Russia combined lost 3%. So all the gains of the growth in recent years have accrued to the United States. As such, it shouldn't come as a big surprise, the demise of this alliance. However, the timing is quite unfortunate, as it has added a supply shock to the demand shock that's already been in place due to the ongoing coronavirus pandemic. Now, the primary victim of this price war for market share is also going to be the US shale industry in light of their high cost structure. Not only is US production about to plunge, the very survival of a lot of these players is at stake. Looking at the corporate bond market in the high yield segment, the whole energy sector is already trading at distressed levels and seems to be in significantly worse shape than it was in the last crisis in 2015 and 16. As most observers are aware, the US president's relationship with the truth can be quite liberal at times. As such, many of his pronouncements have to be taken with a big grain of salt. So far, no deal has materialized, and it remains hard to imagine, given the background that we just touched upon, that any lasting arrangement can be found that will not include contributions by other major producers, as well as the United States itself. Now, US participation faces a number of obstacles. For one, there's antitrust laws that prohibit such coordination. A lot of the US industry players, such as the large major integrated ones, ExxonMobil, Chevron, are adamantly opposed to such cooperation as well. But the alternative threat of instituting tariffs on imports does not seem to be a viable solution either, as it will simply raise US domestic oil prices above global levels. So far, the market remains quite hopeful and is looking forward to the emergency OPEC meeting taking place later this week. Despite the enticingly low prices, we would caution investors to refrain from jumping headfirst into crude oil-linked structures, ETFs, or futures contracts. For one, we do not expect a V-shaped recovery in short order. The demand shortfall is expected to amount as much as 20 million to 30 million barrels per day. So even if a cut of 10 to 15 million barrels per day comes through, the effect on prices will be rather limited, and upside potential at this time is limited. Secondly, the demand shock has served to turn forward curves in the crude oil markets into very strong and extreme contango, similar to what we saw in 2009. As such, the headwind in terms of cost of carry is tremendous. In fact, the contango between 1 month and 6 months alone amounts to nearly 30% at this time. Our preferred way instead to play an oil recovery is to focus on oil equities. We recommend focusing on major multinational integrated oil companies, but avoid regional players, pure E&P players, and definitely oil services companies. The major integrated oil companies have comparatively healthy balance sheets, offer significant dividend payouts of as much as 10% at this time. Now, we expect quite a few of those to be cut, yet compared to the broader market and given low valuations, these names remain quite attractive.